Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about the leisure and lodging sectors. We're doing that now because in the last 2 months, macroeconomic factors indicate that there has been some weakening in consumer metrics. Now, the questions that come from that will be ably answered by our analyst extraordinaire, Jody Lurie, CFA. She is a senior credit analyst for Bloomberg Intelligence. She covers companies in the leisure, lodging, gaming, restaurant, and rental car sectors. Prior to joining Bloomberg, Jody worked in various roles at Janney Montgomery Scott and Citigroup Smith Barney. In May 2016, she testified before the U.S. Senate Finance Committee during the hearing Debt versus Equity, Corporate Integration Considerations, in case you want to look that up on C-SPAN. And she graduated magna cum laude from Bryn Mawr College. So welcome to the podcast, Jody.
Thank you for having me, Rob.
So let's start with those macro issues that I was talking about. So some of the consumer data, which is principal for your sector, started turning down about 10 weeks ago, or maybe 8 weeks ago. We've also, from a top line perspective, had a decline in GDP growth forecasts across the board from all the Wall Street firms. We got consumer confidence numbers that are weaker, although relatively still pretty strong. And most Wall Street forecasts of unemployment and spending are not that great either. So, however, you all do a survey that anyone on the terminal can get that indicates that consumers will likely continue to prioritize travel expenditures into at least the near term, if I understood that data right. So how do you read all of that stuff together?
Well, that's definitely a big mix of positives and negatives. So let's take a step back. I mean, the one thing that I will say about surveys that's a little bit difficult is obviously they're point in time measures of how a person feels. So if we were to run the survey now, which we actually do a mid-year survey, so stay tuned in a few weeks for that. But if we were to run the survey now, it might look a little bit different than a survey back in November when we ran it last. That said, I mean, I will say that the consumer has continued to be surprisingly resilient. And when it comes to travel and vacation spending, they're still extremely protective of that time. And particularly for the companies such as cruise lines, for example, where people book well in advance, they're going to continue going on those until they get to a point where they feel tremendously constrained. So I think that there's a little bit more of a delayed effect for some of the companies in my sector over others. Now where we are seeing signs of stress that we already saw last year is in the restaurant space. And, you know, there's lots of headlines around restaurant restructuring, a lot of companies taking bad moves in terms of their management. Classic example, Red Lobster, you know, with the sale leasebacks. But beyond those companies, you know, you are seeing that consumers are being a little bit more selective in their discretionary spending. Retail, which my colleague Mike Camplone covers, has certainly felt it a bit more. My space, a little bit less.
Okay. So the other thing that I think is a little bit difficult to understand sometimes is that we've talked about this separately in preparation for this podcast, is that consumer data can be illusory and a little bit ineffective to understand where you are now. Can you talk about a little bit, because you've had some experience of this over time, can you talk about how this weakening of consumer data compares to other times?
So consumer data is pretty tricky because you'll get a read that looks bad, but then it'll be fine the next time around, right? And it's until you start seeing a pattern and until you start really sort of feeling that that average consumer is pulling back, you're not really going to see a cosmic shift. And similarly, post-pandemic, everybody sort of rushed into that revenge spending is what we called it, right? Where everybody was stuck at home, they wanted to spend. And I don't think we're at the point where it's that reverse of revenge spend at the moment. But I do think there is an element of moderation. And a lot of the companies in our space, such as the hotels in fall of last year, and we wrote actually extensively about this, were communicating that they are seeing pockets of moderation in certain parts of the world, as well as certain types of consumer. Now, the low-income consumer, we have seen a dichotomy between them and the high-income consumer, right? The low-income consumer doesn't have the same stimulus checks that they once had. They don't have that cushion. They're feeling strained by eggflation, which is what people like calling it, although it is inflation beyond just eggs.
Yeah, sure.
But I don't know about you. I mean, I even if you do Walmart orders, it's $5
right
for a 12-pack of eggs. It's outrageous.
Right.
And that's at Walmart, right?
Yeah.
You know, and it's just incredible to think about that we have all these components, and the Ira Jersey has talked about obviously what the Fed says, but really at the end of the day, that inflation component and what's been communicated is that we haven't really gotten that under control. And so between that and how the consumer's feeling, I mean, you might see that cascade over, but it might be delayed for my space.
Okay. Well, let's get under the hood of the companies, as you referenced earlier, because they tell you a lot. So, when I was doing some research and reading some of your writing on the terminal, there's a big difference in sort of share buybacks, CapEx, debt repayment priorities, all that stuff. So where would you like to start with that? Because I'm ready to dig into any of those things.
They're all related, right?
Yeah.
So let's look at it by types of companies that I cover. So the gaming companies, for example, they were big into debt repayment for quite some time. They've now gotten to a point where their shareholders have become impatient, and so they've pivoted into share buybacks in addition to their CapEx plans. A bunch of, particularly the global names, such as the MGMs, the Winds of the world, the Las Vegas Sands, although Las Vegas Sands is sort of a misnomer, other than the fact that they're based in Las Vegas, everything's in Macau and Singapore. But those companies are really focusing on CapEx, right? They're focusing on those new projects such as Winds in the UAE or MGMs in Japan. But beyond that, they're also giving back to shareholders because they say, well, we built up all this cash. We're now at a point where our leverage isn't so bad. And so we feel a little bit comfortable. You pair that together with the fact that they don't have the same catalyst they had a year ago in terms of volumes in Vegas. And you sort of say, okay, well, what's going to propel them further from a credit perspective? And we don't necessarily see that with any of those companies. Now, Caesars is sort of an outlier in that they still communicate that they want to get leverage down below a certain point, but they are also sort of folding in share buybacks when appropriate.
Right, because they're kind of close in terms of overall borrowing to the others, right? They're just getting there. They started a little later. Is that right?
Yes, it's a combination of things. Caesars is actually a product of Eldorado and Caesars that went through the restructuring. Right. The management team is Eldorado. They're a bit more conservative in how they run their business than Caesars, LBO Caesars was. I mean, LBOs are a whole different animal, so it makes sense.
Yep.
But even so, yeah, I mean, it's a weird sort of a dynamic for Caesars because they're so domestic, right?
Right.
So you have the other companies got that lift with Macau that has kind of died off when Macau reopened.
Right. And there was a massive growth of the Chinese upper middle class traveler that reconfigured everything.
Exactly. Now that can go the other way going forward. My colleague Cecilia Chan and I, we cross cover a lot of the names that have Macau exposure. And the two of us were chatting the other day. And one thing that we're sort of thinking is, at least in the short term, we might see some effects of these tariffs, which are ripe and new and everyone's top of mind. We might see some effects of U.S. tariffs kind of carrying over into the Macau sector, combined with the fact that China hasn't produced the best numbers of late.
Right. Yeah, there's weakness on that side too.
Correct. Yeah. And we are seeing the China stuff flow into other companies such as the hotels, right? So what's interesting is Europe and the US and Caribbean, Mexico, those are all hot areas for a vacation destination, right? People are going there. People are going to conferences. People are traveling. In Asia, it's still a little bit more of a mixed bag, depending on if you're talking China or not China. Mm-hmm. And for vacation spending, we are seeing a tremendous appetite for the Caribbean. We're seeing a tremendous appetite for Europe, and that's playing nicely for the cruise lines, for example.
Okay. So let's talk about cruise lines for a second, because that's a big part of their impetus, but they have some other things going on. So get under the hood of those folks for a second.
Right. And we spent some time with Royal Caribbean today at their investor day, and it's interesting to listen to these companies now, right? Because we met with Carnival a few weeks ago, met with Royal Caribbean, and the narrative is so different now than it was a few years ago. These companies borrowed up the wazoo during the pandemic. It was a very, very difficult turn for all of them. They were not allowed to operate. So here they had these massive vessels, which if you're not operating them, I mean, they still have maintenance CapEx, right? They cost a lot of money to maintain. And even if you mothball them, you still have people who are physically on the ship just to make sure that everything's running, right? And so they had a lot of catch up to do. Now, Royal Caribbean did get to investment grade ratings by S&P. Carnival, their secured is investment grade. The companies have worked towards their investment grade ratings, and that they're still focused on that. And that's still a part of their story, but you are seeing a pivot. For Royal, you're seeing a pivot towards growth. You're seeing a pivot towards expansion of their fleet into river. You're seeing an expansion of their destinations, a lot more destinations that are on the books going forward. They're also talking about giving back to shareholders, but they're talking about it from the standpoint of a much more measured approach than some of the other companies within our space that are really going full force into shareholder rewards. For Norwegian, it's a little bit different because they're using EBITDA growth as the means to get leverage down as opposed to actively paying down debt, which is different than what Royal and Carnival did. Viking reports next week, but they've been pretty dead set on being happy with their leverage, which is actually the lowest of the bunch. And I don't think that they care to get to investment grade level ratings. But management seems pretty happy with how they're operating. The narrative could change next week. The reason being is Royal announced on their earnings that they're going into river cruises. And so the big question is, what sort of threat is that to Viking, who has really kind of cornered that market?
Right. Yeah, that's going to be exceptionally interesting. How do you all look at that from an overall sort of debt perspective? That sort of perspective competition?
The perspective competition, I mean, it's really a question of if there's enough consumer appetite. Because if it's a situation where there are so many people who want to do river cruises that, Viking's so heavily at capacity that there's enough space for Royal, then I don't think it should really be an issue. You can only really have so many ships in the water. At the same time, you're always turning over ships because ships get old. You have to put them out to pasture. And even so, I mean, you talk about that wealth distribution, you talk about the baby boomers who are the key target for these river cruises. And for now, I mean, I think it's a sort of interesting play, but it does beg the question of, okay, for future generations, is that momentum still going to be there? Are they still picking up these new to cruise customers that they've been talking about the past few years? Is this still an appetite? Are you going to see that same cash flow? And where we have been concerned, and bringing this back into the overall macro topic, is we haven't seen bookings pare back so much. So people are still booking their cruises out into this year, into next year. But the question for us is whether people continue to spend in onboard spending like they have the past few years. Right. So you're buying the excursion to go snorkeling, or you're buying the drink packages. People have been dishing out the cash on those. And that's where the margin is. That's where the cash flows come from more than anything. Filling up the ship does provide cash flow, but to get that extra bump is in the onboard spending. And if people have in their mind, yes, I'm going on this vacation. Yes, we're doing this big family trip to the Caribbean, and it's 20 of us going on a family reunion. But oh, look, my job is uncertain. I'm a federal employee. I don't know what's going on with the stock market, whatever it may be. People might feel a little bit more uncomfortable to spend on that onboard spending. So you'll see that cascade into cash flow.
Right, which makes a type of sense because it is essentially a liquid expense, right? It's
right.
Not, it's not.
Right.
It's not fixed.
Right, and that's more of a spending that you do while there. The companies have shifted their strategy to get people to spend more when they're booking. So you do the onboard spending as you're booking, similar to an airline. If
so
they
try
say,
to bring it earlier into the
right, exactly how an airline says, do you want that extra bag? Do you want to pay for the seat room now? Those sort of things that the cruise ships have been doing more and more of that, just to kind of lock in the money now. But I think we'll start seeing, especially the latter half of this year into next year, that people might not be as apt to just put that money in. They'll reserve their cruise and they'll say, okay, I'll cross that bridge when I get there, about how much I want to spend on drinks, how much I want to spend on all these extra items.
Right, based on how I'm feeling.
Right, how I'm feeling, what's in my wallet.
Well, let's take a look forward then, because over the last 20 years in this country, we've had a divergence between the wealthier and the less wealthy Americans, and it seems like that's going to keep going. I don't see much public policy that's going to stop that, either in the forms of actual policies or taxes. So, how do you model that over the credits that you cover?
It's a tricky question, Rob. And the reason is that for some of the companies, it's very easy to see that they'll still do well. So the Marriotts, the Hyatts of the world, they target the luxury consumer. Right. They're also providing more product or type of vacation, type of hotel or lodging experience that fits with that sort of new experience. So
through their different properties.
Right, through their different properties, different property types. So Hyatt bought Mr. and Mrs. Smith, which allows access to boutique hoteling. Marriott just bought this outdoor hotel experience that is sort of like an Airbnb, but for outdoor. And so it marries together a lot of what, the Gen X millennial are thinking as compared to the boomers. So traditional hotel isn't always what people want. And we're seeing that Airbnb is definitely taking over some component of the business, Airbnb, Vrbo, all those alternative to traditional hotels. But for some of the other companies, such as Choice Hotel, for example, which we cover, they do the extended stay, they do the lower market type of hoteling. They have expanded a little bit more into middle market. But the question I have is if you'll see a trade down, meaning will people who usually do luxury, are they going to say, well, maybe I'll save some money and I'll just stay at the cheaper option? Or is there a certain point where they say, I'm going on vacation or I'm going to a conference, I'm still going to spend on this nicer option because I can, or I'm just going to make sure that I have the budget to do that. And I think that's sort of the trickiness of it is you say, okay, is a Choice going to win out? Or is something like a Marriott or say a Hilton, which offers everything, is that going to win out because it's sort of catering to all types of consumer? And whereas the low-income consumer is not going to be going on vacations, not going to be going to conferences, for that middle market to upper tier consumer, what are they going to do, particularly if we feel the strain for the global economy, however it comes, whether it be tariffs and inflation or whether it's some sort of trade war or war of geopolitical levels of Russia, Ukraine, I don't know.
Yeah, this is where this gets exceptionally difficult to model because, most CFAs will shrink from someone saying, well, it depends on how the consumer feels. But it's all riddled throughout your credits.
Yes. I mean, that's basically, we're constantly sussing out, okay, is the consumer feeling okay? And what's funny is a colleague sent me this tweet, it has a lot of credence, a tweet of somebody who was in Vegas and they took a video of some portion of the strip and they said, Vegas is dead, nobody's here, blah, blah, blah. And this was last week. And they said, the data is deceiving at the moment. But then I had another colleague who was actually in Vegas last week. So when he came back, I said, hey, can I ask you, how did it feel on the strip? And he said, oh, it felt great. It was so vibrant. So I think it really just depends on the person who's looking at it. The data isn't so much indicating that there's a significant pullback, at least in these hotspot consumer spaces. Now, what becomes more interesting is for regional casinos, for example. And that's where it's sort of weird because if you talk to any of the companies, their narrative, and I think this is based on somebody's research at some point, their narrative is that regional casinos are actually counter-cyclical.
Okay.
Which you could subscribe to that because people don't want to go on a flight to Vegas. They can't afford it. They'd rather just go to random Ohio casino, right?
Right.
Makes sense. But the problem is when you think about even in the New York metropolitan area, how many additional casinos, racinos there are beyond just say Atlantic City now. Over the past 20 years, it's just ballooned. And we have the 3 downstate licenses that might be granted at the end of this year, right? And so you think of the Catskills, you think of MGM's Racino and Yonkers. There's a lot of options now. And does it become cannibalistic? Never mind the fact that you now have online gaming and sports betting that encourages people to just stay on the couch. So if you're really feeling the pinch, you don't want to spend money on gas. You don't want to spend money on wear and tear in your car. You'd rather just stay at home, use your phone and bet and feel like you're making money.
Right. In addition to that, there has been some research into what might happen at the lower end retailers during some type, are they counter-cyclical? They've not really been. Maybe they will be someday, but
Maybe.
um,
Yeah. And it's, I don't cover Target, but I did catch the headline that it was mixed and it wasn't actually as bad, but people were really reading into the negative parts of Target's comments, just like Walmart, when they reported, people were really reading into the negative parts. Again, don't cover them. Mike Campione writes fantastic research on both. But you think about it in the context of the consumer and what they're spending on. Now, for us, what we saw with our survey data back in November, which I encourage everybody to look up at the terminal, is that at least for those who are planning on going on vacation this year. So we survey people and we get about 1,000 people who say, yes, vacationing is one of their priorities of this year among multiple priorities. And of those individuals, they're more willing to spend on vacation than they are on retail, significantly more. And that's even higher going into 25 than it was going into 24. So I do think there is a component of a shift in the mentality of the consumer where they're saying, I have so many goods. I don't need goods. Goods aren't going to solve it in life. I stared down death with COVID. I got stuck at home and I want to see the world because life is short. And I do think there is that mentality that will carry over to some extent, but only to a point.
Right. That's the hard part of being a bond analyst.
Right, exactly. You say, what's that point?
Right. What is
and
that
at
point?
what point does that mean that we're not going to have cash flow growth? At what point does that mean that companies are going to feel the strain and they're going to start borrowing? And to that end, I think you brought up M&A earlier and we didn't discuss it, but we are seeing some of the companies pick up some M&A. We're seeing some companies go full force into it. Choice tried to buy Wyndham a year ago.
Tried to, yeah.
Failed disastrously. Mm-hmm. But you are seeing companies do a little bit more of the tuck-in type acquisitions just to keep themselves vibrant and interesting. I do sort of wonder at what point that shifts into take privates or that shifts into massive sort of consolidations of two companies. I think there's some companies that are positioned well to do that and some that are definitely not.
Yeah, there's a really interesting set of impetuses in the take private option, right? Is get them off the higgledy-piggledy stock market.
Exactly. And especially with when you think about it in the context of private debt and that segment of the market just booming, you wonder at what point companies say, you know what, I can access private debt markets at almost the same levels and maybe even better levels. I don't have to be under the scrutiny of all these sort of components. I'm just going to go private, use the private debt markets, maybe try to do public debt issuance if I really need to. But at the end of the day, why do I need to be public? Why do I need to have that quarterly scrutiny? You think of, right, exactly. Rob Schiffman writes about Dell, and I always think of that company as a company that just got so tired of being public and did, the management buyout. And it was solely because Michael Dell just wanted to do stuff with the company and didn't want to have to answer to shareholders all the time.
Right. Yeah, it's exceptionally compelling. Well, thank you, Jody. Let's leave you here. This has been a lot. So Jody's, you do a twice a year survey, right?
Correct. The survey's twice a year.
Exceptionally. How long is it till the next one comes out?
A few weeks.
Okay.
So we try to do it every 6 months or so.
Yeah. So those of you who are on the terminal, you can go to BI and you can find Jody just by looking up her name. You can find it there. You can find it. There's all types of ways, but Jody is a BI analyst, so you can find her on there. And she mentioned a couple of other folks that you'll find on there too. I recommend it. It was fun for me on Friday. So thank you, Jody, for being here.
Sure thing.
And thanks to everybody who's listening to this. These consumer issues are going to be part of all of our events coming forward. So take a look at our website, see if there's something on there that piques your interest, and please come see us soon. Until next time, I'm Rob Rowan, and this has been Compound Insight.